Okay, good morning, everyone, and you're very welcome to our latest Coffee Microcaps webinar. I'm Mark Tobin. I'm the founder of Coffee Microcaps. For anybody who is joining us for the first time, you're very welcome. And for all our regular attendees, welcome back. And indeed, our viewers on YouTube, you are welcome to this session. And I would like to give a mention to DMX Asset Management, our virtual event sponsors here in 2026. We are looking for an active fund manager in the microcap space and the small cap space. And please do check out their website for the relevant TMD and PDSs for their two funds, or indeed, please reach out to Stephen or Michael at DMX, and I'm sure they'll be able to answer any questions you might have. Quick compliance and disclaimer slide, and as always, a welcome to our friends from ASIC. For anybody who is joining us for the first time or watching one of our videos live on YouTube, the companies we tend to have on here capped under 300 million, our definition of a microcap, in revenue and approaching cash flow break even, or indeed already profitable, as we'll see from some of our companies presenting here this morning. We tend not to have companies from the resources and biotech sectors, what I like to call industrial microcaps, which covers kind of everything outside those two sectors, from industrial businesses, financial services, healthcare, technology, retail, professional services, kind of anything that falls outside of resources and biotechs. This morning's webinar, jam-packed. We have 4 companies presenting this morning, each 30 minutes, which will roughly break down into a 20-minute preso and 10 minutes of Q&A. If you do have any questions for our presenters, please type them in the Q&A box rather than the chat function. It just makes it easier for me to moderate the questions to our presenters. And please note the webinar is being recorded and will be posted on the Coffee Microcaps YouTube channel tomorrow morning. And all our sessions are recorded and on the YouTube channel. We've had over 20 companies presenting in the last couple of weeks post-reporting season, so there's plenty of new content up on the YouTube channel. You can follow us pretty much everywhere. Twitter, LinkedIn are our two big ones. YouTube, as I say, for all our content. And I do write a free monthly newsletter, which you can get on Substack. Our lineup for this morning will shortly be joined by Andrew Booth, here for the first time with us, I'm delighted to say, from Advanced Braking Technology. Then we're going to hand over to James Frayne from Felix Group, coming to give us an update on the business there. Then we will switch to Troy Mortleman from GALE Pacific. And finally, we're going back out west to Sam Budiselik, who is joining us from Cash Converters. But I will stop sharing there. And Andrew, if you could please share your screen.
Sure.
Good morning. Andrew is very kindly joining us early in the morning from WA here.
Thanks, Mark. So I'll kick off. Delighted to be here at Coffee Microcaps, presenting our latest results for the half year. Today, we're just going to cover off an overview of the advanced braking technology business model, our market, the competitive dynamics of the market, and just some of the strong tailwinds that we currently have for the business. I'll talk a bit about our technology and our intellectual property, and give you a bit of a growth forecast for ABT. ABV is our ticker. So without further ado, I'll get into who ABT is. So Advanced Braking Technology is a brake and technology safety solutions company. We are an original equipment manufacturer of brake systems that's a solution for very high risk, harsh environments such as underground mining and also surface mining. We have safety solutions that have very strong patented intellectual property, and we sell to some of the largest mining companies in the world. AVT has been cash flow positive and profitable for a sustained period now of over 5 years, with a market cap currently sitting at the $55 million mark. So just a bit about AVT at a glance. We have a 25-year track record of ongoing investment and innovation in proven safety technology. We've got very deep experience in mine safety, and we, as I said, we're solutioning for some of the largest mining companies around the world. We have a large addressable market, so our technology is agnostic to commodities. We've got a very good spread of geographic diversification. We've got very strong upside in terms of market share growth globally, and our technology is strongly protected by patents. We've got very strong customer relationships, supplying leading blue chip customers in industries where safety and reliability are absolutely critical. Our mission is to protect our customers' people and assets and provide them with optimal operating efficiencies moving forward. AVT is both a capital and people-light structure. We don't have a great deal of capital-intensive infrastructure needed to produce these brakes, and we're relatively people-light. There's 30 people in our company, and we're demonstrating very strong operating leverage, which is showing good levels of productivity as we're scaling on a relatively stable fixed cost base. AVT's got very strong financial platform. We've got a very strong balance sheet, no debt, and we're sitting in a very comfortable cash position at the moment, poised for investment, and we've got some really compelling growth drivers. So yeah, the long-term demand that we're seeing for minerals, combined with a demand for safety and technology solutions, and this includes a growing appetite for autonomous operations, which I'll talk a bit about. So who are we? So AVT is, as I said, a brake OEM. We just happen to have products that are very specific and tailored to the mining sector. We have a range of different brake solutions. So on the left-hand side, you can see here that we've got a driveline brake, and this is essentially a sealed integrated brake system that is fail-safe. Fail-safe means that it works in opposite to a regular car brake. It takes energy to keep the brake disengaged, and when all else fails, the brake locks on very strongly. So we produce brakes that retrofit to road vehicles for mine applications in the form of a driveline system. We've also got in the middle here brake safe wheel ends brakes, and this also provides the safety of both primary and secondary activation interlocks. So you've got a big red button on the dashboard, but it's designed for guys and girls that are jumping in and out of vehicles on very steep inclines in challenging environments. So if you switch off the ignition, release the seatbelt, or open the driver's door, if you haven't already engaged the park brake, the brake engages. So it's designed to be absolutely foolproof and designed around humans and their behaviors, often in high pressure environments. Brake IQ, I'll talk about in the next few slides. Brake IQ is an autonomous braking system. It's a very exciting product. that plug and plays with collision avoidance technology and provides operators with a level 9 system that will not just alarm the driver if there's an obstacle in front or behind the machine. It will override that driver and automatically apply the brake in an emergency. This brake system solutions for yellow equipment. It's solutions for both surface operations and underground. It's a very exciting product development for AVT, and we've got some very ambitious plans for this product. So this just shows you the types of vehicles that AVT solutions for. Our bread and butter is in light vehicles and road trucks. So the Toyota Land Cruiser, which is the workhorse of mining around the world, is one of our most popular brake systems. We've also got a system now for the Toyota Hilux, and then in the driveline range, we solution for light vehicles, ancillary equipment like telehandlers, and then light, medium, and heavy trucks. On the right-hand side here, you can see that there's collision avoidance development going on in our brakes. We will have collision avoidance capable autonomous braking systems in the market in next financial year, FY27, which is a really exciting development for AVT. So this is just covering the quality of our revenue profile. So we sell into over 22 countries around the world. We've got sort of a split of revenue that's domestically here in Australia is making up about 55% of our revenue. It generally is about 50%, but at the halfway mark, Australia's performed very strongly versus rest of the world. 45% contribution of international. It's generally about 50%, and probably will end the year at that mark. Importantly, and an important aspect of the operating model and the revenue model for AVT is that we've got very strong, recurring, sticky, high-margin revenue in aftermarket sales. Like any automotive OEM, AVT is able to yield very strong recurring revenue for the life of the brake in the field and operation. This is made up of brake pads, our fluid solution, seals, and spare parts and other consumables. So that's new brake sales only makes up about 50 to 55% of our revenue. The rest is trailing sticky recurring revenue with our end users. We've got unique IP, so 70% of our revenue is protected by patented proprietary technology. And we've got a very strong blue chip base of mining customers. The largest miners in the world, direct sales to 10 out of the 20 global mining companies. And indirectly, we're probably covering all 20 of those global mining companies through our distribution partners in markets such as Africa, Southeast and North Asia, and in North America. So just FY26 highlights. Revenue at the halfway mark was up 27% on prior year. We're delighted with this result. That's made up of both new brake sales up 25.8% and that trailing aftermarket revenue up 28.4%. We've got sort of revenue segmentation here, which you can see on that middle top box. You can see there the split between new brake sales and aftermarket, and we're increasing our profitability. Net profit before tax was $740,000 and up significantly on prior year. I think you can see here our gross margins at 48.7%. Very good, strong, sustained margin. Our cash is up 44%, and actually that profitability is up. I think it was about 60% on our NPAT for the year. So we've got a really strong. That's backed by a really strong balance sheet, as I said before. We are achieving these results through executing a very clear growth roadmap. Our domestic sales were up 30%, international was up 29%. Really strong growth we're seeing in Australia, Canada, Mongolia, and Europe. International revenue is driven by that blue chip customer engagement. The Rio Tintos, the Glencores, the Vales, the BHPs of the world, all about engaging and expanding our install base across these tier one miners, across their mining fleets. Strong gold, copper, and platinum prices are really driving a lot of investment and operational demand. And we're seeing good, we're continuing to innovate. So ABT has been innovating for the last 20 years, brake and safety systems. We've successfully deployed the CIBS fail-safe brake range across JCB telehandlers at Rio Tinto's Oyu Tolgoi copper operation in Mongolia, one of the largest copper mines in the world. And we've also secured just recently a mandate to supply fail-safe brakes into MMG's Dugald River mine in Queensland. That's one of the top 10 global zinc operations. Our technology development, so as I said before, we're really investing heavily in technology and collision avoidance technology. And South Africa at the moment has a mandate for level 9 collision avoidance. And so we're targeting this technology safety product development at that market, but also more largely globally. So you can see here just the performance of the revenue by quarter. So half on half we're up 27%, but our 4-year average CAGR is around sitting at around 19%. We've had record results for half year revenue at $11 million. And you can see here that we've got consistent multi-year revenue momentum since FY 2023. Technology and safety. I'm just going to talk a little bit about where we're really investing a lot of our resources into, and this is all about automation. We see autonomous operations as the future over the next 10 to 20 years, and we want to be a part of that. Whether you've got drivers in the vehicles or not, we want to have brake systems that solution for that future mine operation. Currently, where that's at is collision avoidance level 9. This is the global standard at the moment for autonomous safety. So CAS 9, as I said before, is all about not just warning the driver with an alarm, but overriding the driver in an emergency. And the problem that we're trying to solve here is that there's very high fatality rates and mining deaths involved in when vehicles are interacting, and that metal to metal contact creates a lot of safety issues for operators. And so it's all about having active intervention, moving from passive alerts to active life-saving braking. You've got human behaviors here, and of course, where you've got very high recurring vehicle operations, you get fatigue, you get distraction, and you also get alarm fatigue. Autonomous safety, as I said before, overrides the human when a collision is imminent. There's also a compliance and regulatory guideline now in South Africa. Collision avoidance level 9 is absolutely the global standard future for safety moving forward. So Brake IQ is a new product that we've recently launched into the market. It provides operators with a retrofit autonomous brake solution that is a very economic solution for operators. It uses an electric motor to depress the brake pedal, simulating a human foot rather than cutting into the complex hydraulic and brake systems of these vehicles. It's plug and play, so it will plug and play with any collision avoidance or proximity detection technology that might be in that operator's site. And as I said before, it's a very quick and economic deployment. We're very excited about this product moving forward. So for ABT, we've got very strong growth drivers delivering sustainable earnings growth to our shareholders. We've got a really large global addressable market in mining, where we are sort of unapologetic about our concentration on the mining sector, because we've got so much room within this industry to grow. But we will also diversify, and we have done, into other industries in our growth horizon, including defence, transport, and civil construction. We've got really positive long-term industry growth drivers. So there's a very strong demand for minerals and the need for continued underground mining operation expansion and investment. We've got increasing regulatory requirements around the world, a very strong focus on safety in whatever jurisdiction you're working in. And there's a very strong move towards autonomous zero-entry mines of the future. And that's why autonomy is a very important part of our future growth roadmap. We're investing heavily into, and we're seeing increasing investment in defence and civil construction in this area as well. ABT has a people-light and a capital-light business model. We've got very disciplined cost control, and we're working on a supply chain strategy, which is a multi-year strategy, which is foundationing us for growth. And we're investing in our people, systems, and technology that will springboard this company into the future. We are delivering strong return on assets, and we've got an increasing free cash flow base on our existing asset base. So what's the outlook? We'll continue to focus on our blue chip tier one mining customers, a very strong customer base, strategic account management wrap around these customers as we continue to deploy and expand our install base of brakes around the world. We will continue to invest in product innovation with a very strong technology focus. Our SIBS product development will give us a broader vehicle application moving forward. And as I said before, we've got a very strong multi-year supply chains expansion strategy to help us continue to scale and drive economies of scale through our factory. We've got a compelling outlook. So we've got global underground mining growth is buoyant and long term. We've got a market size expected to exceed $47 billion by 2032. You're seeing really strong regional leadership coming out of our region in the Asia region, led by China, Australia, and India. North America is anticipated to continue to experience very strong growth under the current geopolitical lead. And automation and zero-entry mines are absolutely the mines of the future. And ABT is early in the curve, but we want to be there for that autonomous operation down the track. And we've got strong emphasis on sustainable, responsible mining. Focus on electric machinery and energy efficiency and efficient optimal operations. So that's ABT in a nutshell. We're delighted with the results we've delivered year to date. We've got a very strong growth horizon ahead of us that's got really strong tailwinds and a very good focus on AI driven technology and autonomy. So that's the presentation. Thanks for having us. Mark, if there's some questions, I'll take them.
Thanks, Andrew. I might just kick off with one or two here, just to get the ball rolling. Just on the the split between, direct customers versus distributors. I mean, do you have a preference on a go-to-market strategy long term, or how do you decide when you'd rather supply yourself versus engage a distributor?
So in Australia, our domestic market, we are direct to end user, and that's very important for us because we've got the largest mining companies here, right here in our own home market. In offshore markets, we work through distribution partners that have the same market presence on the ground and the local knowledge and relationship with these mining companies and their operations locally. Look, as we scale and we grow, we will likely look at investing in offshore hubs. But at this stage, we're working really strategically through our partnerships. Of course, selling direct to customers, cutting out that middleman gives us a superior margin and yield. It's about balancing that dynamic. Yeah, look, as ABT grows, we'll also grow our footprint and our presence globally.
I know you talked about, maybe moving into adjacent sectors, like, civil construction, transport. Is there anything on the regulatory front in those markets similar to Cas9 in the mining that's, forcing, if I think of some of these, major infrastructure projects, doesn't matter where you are in Australia, a lot of them are underground tunnels, either for trains or new bypasses. So, there's a lot of civil construction work happening underground, but is there similar regulations that are, would be in favor of ABT's product moving into those adjacent industries?
Yeah, look, mining definitely leads the way in terms of safety regulation in underground and surface operations. In parallel industries, what we're probably more likely to see is best practice. So emulating some of the technology and really good, strong safety compliance and regulatory frameworks in mining is often replicated in some of these parallel industries, and underground tunneling is a really good example of that. Look, whether it's best practice or whether it's a mandate, ABT has a really strong go-to-market approach where educational marketing around safety, it optimizes operational and productivity and basically saves lives. So it's a pretty compelling proposition that we've got, whether you're underground in a mine or underground in a tunnel or another high-risk environment. We've got a solution for you.
And we call it the sales split there between, new units and then the consumables piece. Should we expect that split broadly to stay the same as sales increase, or should we expect the consumables maybe to tick up a bit more?
Look, you should see a good 50-50 split continuing in the future as we grow our install base of brakes. You'll see commensurate growth in aftermarket at that really high margin yield. Yeah, I think as we're seeing double-digit growth in new brake sales. You'll see commensurate trail, which is a really great investment dynamic that our shareholders and investors should take a good deal of attention and focus to.
In terms of, I guess, main competitors to your products, is it other kind of specialist brake manufacturers? Is it the OEMs themselves, kind of Dynapack Chinese OEMs, creating their, doing the R&D themselves and just, building it in from the ground up, or is it, even, I don't know, just a lack of regulation in certain mining jurisdictions that it's not needed. So we kind of are not enforced. Maybe I won't say not needed. Not enforced as diligently as it might be in, say, the Australian Canada.
Yeah, this is a very specialized sort of requirement for brake and safety systems, and I call it kind of heavy industrial, high risk environments. A lot of automotive OEMs won't go there because it's simply they're solutioning for passenger on-road vehicles. Where ABT plays in a very, very strong niche is that we retrofit road vehicles to be mine spec'd for optimal mining. What we've done is we've basically taken the fail-safe brake technology from a yellow machine, and we've miniaturized it so that it can retrofit onto a road vehicle and make that vehicle mine safe. Essentially, that's a really unique space to play in. But we've got really strong IP in this area, and we've got a brand that's synonymous with mine safety and braking systems around the world. We've got other competitors, but they don't have that same deep experience and presence in the mining sector. ABT really has that, and that's a real standout competitive pillar for us.
Andrew, we leave it there. Thank you very much for joining us early in the morning there in Perth. Very much appreciated. If I could ask you, please, to just stop sharing your screen, because I do know we have our second presenter standing by, James Frayne from Felix. James, good morning.
Mark, how are you?
Very well. I can hear you, James. If you want to just pull up your presentation, I'll let you know once I can see it on screen here.
Sweet, will do. Can you see that one?
It's just loading now, James. Just let's give it a second.
Okay, cool.
Yeah, I can see it now, James. If you want to take it away whenever you're ready.
Okay, awesome. Thanks very much, Mark. My name's James Frayne. I'm the interim CEO, CFO, and company secretary here at Felix. So I'll start with, I'll start with our vision. So we consider ourselves the trusted supply chain platform for the built environment. So what exactly does that mean? We see our clients utilizing our platform to ensure that their procurement practices for their supply chain are best practice, and that ensures that their projects are therefore able to be safe and delivered on time and on budget. So I'll just start firstly with a quick founder story as to how Felix came to be. So initially it started on the back of the mining boom. The founder was sourcing plant and equipment and trades in a remote mining location, and found it very difficult to order plant equipment or trades that were up to the specifics that were required to meet safety or specific project controls or specific procurement practices. And being in such a remote location, lead times getting it onto the site meant that those were paramount. And if there were issues, then the project was at significant risk of running behind time and budget. So that brought about the genesis of a vendor marketplace, a place where, like your realestate.coms, your Seeks, you could put out and compare apples for apples, whether that's bits of plant or whether that's particular types of trades. That business was, as I said, the inception of Felix, and it wasn't until about 2015 or 2016 that the enterprise opportunity presented itself. So a lot of tier one contractors in Australia were utilizing the marketplace product, which was a free product for that section of the market, because what was being charged were those subcontractors or those vendors to list their gear. So a lot of the Australia's tier one leading contractors were utilizing the free product, but what they were effectively saying was they wanted a enterprise grade solution that we had built, like the vendor marketplace, to be able to monitor, to be able to interrogate, to be able to data manage their supply chain, their list of subcontractors, because they run into the tens of thousands for organizations of that size. So effectively, talking back to the slides now, that established the enterprise SaaS platform. And we're now, I guess, market leading. We've got over 70 Australian-based contractors, and we've got a handful of international contractors. We've done that enterprise strategy entirely through organic growth to date. And we're currently running a capital efficient international sales strategy. So as I said, in the half, we were able to secure further international contractors, and we're doing that based from Brisbane, from a real pull approach. We're being pulled into those markets. We've got a rapidly growing vendor marketplace. So that vendor marketplace is effectively now over 120,000 vendors or subcontractors, whatever terminology you want to use, strong. And that is the vendors or the subcontractors of those tier one contractors who are using the platform. The existing founder business that I mentioned, we're still running that. That's been quarantined, effectively ring fenced while we focused on that high growth contractor strategy. It currently provides $2 million of annual recurring revenue. It's got free cash flows. But what we have done recently in the half is made an acquisition, and I'll speak to that later, around our first steps at scaling that vendor revenue opportunity. And then final point that just on this executive summary is we've been disciplined with our cost base through to sort of last year. We were the first full year cash flow positive. Since then, we've obviously done a capital raise to fund the acquisition, and we've got some new strategic initiatives, which I'll touch on, but shows that the discipline that we've had on our cost side. So we'll just run through the contents for today. I'll dig more into the 101 and the problem that we're solving. So this is a very busy slide, and I guess it's busy by design because this is how complex the environment is for project managers or contracts administrators, dealing with just this perfect storm of issues around supply chain. Very topical at the moment, given what's happening out of the Middle East, with restrictions on oil and certain shipping routes. We saw that play out in COVID, where knowing your supply chain, being resilient, I guess, malleable, flexible with supply chain was paramount. Not only that, but procurement professionals are now having to deal with just such an increased regulatory environment and also a reporting environment. So we've seen modern slavery, we've seen ESG, we've seen increased government reporting. It's really intensifying that project environment, and the byproduct of that is cost and productivity pressures, as well as dealing with more and more stakeholders like federal governments and asset owners. So with all of that swirl that lives in the project manager's, I guess, life cycle, we set about to create a unique solution. We replace, more often than not, paper-based forms and I guess legacy systems. So they might be in its most, I guess, junior of how they exist, literally wet signatures on paper-based forms to approve vendors, to approve packages of work or RFQs. And then another sort of element that we replace, or how we have sort of created an avenue for us, is that historically, this has also been solved by generic procurement solutions. So they usually come out of your big software behemoths, your big accounting packages or ERPs, SAP, Oracle, etc. And they're not fit for procurement teams, and they're not fit for projects in the modern age. They capture a lot of information around accounts payable and ABN details, but it doesn't have that depth of data that the Felix platform does. Things like certificates of currency for insurances when they expire, project limits, historic bank of work, understanding what that customer's been able to perform, safety tickets, specific site tickets, etc. And then on top of that, there's the point solutions. So there's a lot of very narrow, I guess, part of the workflow point solutions that exist. There's, I guess, in the age of AI, and I'll talk to our AI elements of our product later, but I guess through AI, there's been lots of sort of part players to the workflow that insert themselves. But you can see on the right-hand side of the slide the differentiators that Felix has been able to sort of purpose build themselves to compete and provide a solution for the end user, which really is best of breed in that regard. So just a bit more, I guess, in depth on our solution and what it actually does. So on the left-hand side of the slide is the enterprise element, and on the right-hand side is the one focused on the vendors. So our enterprise solution has 4 modules. Our average customer pays us $100,000 per annum. Their average customer's on a 3-year contract, and they'll pay us around $30,000 to $40,000 to implement. And then on top of that, we see our implementation as a real key differentiator, because you only need to mention to organizations, especially CFOs, CEOs, around a software initiative or a change management initiative, and they're bearing the scars of a 18-month, 2-year SAP rollout or whatnot. We implement in 6-8 weeks. Specific big bang customers can be 12 to 16 weeks, but you can see that those timelines are really compressed, and we find that we're able to run as fast as customers require us to. Vendor management is the initial starting point. That's what I've touched on, where you're able to capture a rich amount of data from vendors in your supply chain. Those safety tickets, those certificates of currency, the responses to 300 plus pre-qualification questionnaires. Once all that information sits in the Felix system, as an organization, your next step is being able to source from those vendors. Once you've understood what categories of work they perform, what area of the market they perform that work in, the downstream letting of packages to those customers through the sourcing module is the next step. And it's quite easy given that you've got all the information front loaded. The procurement schedule goes by a lot of different names in the organization: a plan of work, a work schedule. It's I guess a project procurement understanding of all the different packages of work and how they are going to be interrelated, and what the status of certain projects, no matter where they occur on the project life cycle, how they're tracking and what their effect, if they're late, if they're early, will be on the on time, on budget performance. So we see that with more and more organizations having a centralized procurement schedule. If you're a head of procurement sitting in Sydney and you want to interrogate a project in Newcastle, in Perth, in Brisbane, you've got the ability to do that. And then finally, we have the contracts repository. So a place to store all your contracts associated with all your different vendors and interrogate those as well. There's some work we're doing in the contract space, which I'll touch on. On the other side of the page, we've got the vendor offering. Started with, as I said, lead management. Customers paying or vendors paying us to have leads. With the recent acquisition we've done of the NextView solution, that's bolted on a much more robust product offering and value proposition. As you can see there, a lot of business intelligence tools, estimation, tendering, etc. I guess the next follow on from there is what sort of industries that we are currently involved in. You can see there that we see critical infrastructure and engineering and construction, our sort of flagship customer, and I guess, most strategic customer was the CIMIC Group. So that's CPB, Sedgman, UGL. But we also have a lot of applicability in energy and utilities, mining and resources, commercial construction, property and real estate. So I'll just jumping over to our logo board. You can see a lot of Australia's largest names in those industries are here. There's a lot of, I guess, variation between where these customers are in their life cycle with Felix. So a lot of customers are, some of the customers are at full scale, like your CIMIC groups, and some customers are just on specific projects or specific geographic units. Interestingly, a lot of these Australian subsidiaries that we have here have large international parent owners, which we have a track record of selling up into, and we're still working those opportunities currently, a lot of these opportunities currently. Touching on to our growth strategy, just quickly, because I'm conscious of time, to save time for questions. So we want to continue on the enterprise or contractor side to continue growing our domestic market share, our domestic customers. So about 2/3 of our pipeline currently is Australian customers, and those opportunities exist in both new customers as well as the sort of what we deem the land and expand. So our existing cohort of customers further growing that account, which is the second sort of element here of our growth strategy. So I think 3 or 4 years ago, our average ARR per customer was around 66,000. That's now just under 100,000. And we've done that through a mix of the different vectors you can see on board. We've expanded the geographies or the users, or different projects have taken out the customers, or we've had additional modules. International expansion, I touched in the executive summary that we've got, I think, 3 or 4 different international contractors. They're based in Canada, Middle East, and Africa, South Africa. But one thing that's really important is a lot of our Australian-based customers have an international presence already. So as you can see on the slide there, most of our Australian-based customers are using them across the globe, using Felix on projects across the globe, and that means we've got 178 international projects on Felix. So it's almost like a lot of the background work to internationalization has occurred. Number 4, vendor monetization. So in the half, we acquired NextSphere, which is a Brisbane-based SaaS platform. And what we see that being is we've had a long-held view of monetizing the 120,000 plus vendors that our contractors have provided into the Felix network or ecosystem or marketplace, whatever you want to call it, monetizing that at scale. We've had those vendors brought in at no cost. We've historically been, I guess, monetizing a very small segment of them, and we haven't particularly focused on really moving the needle and growing into all of them until very recently. We've made that acquisition. We've added out to the value, the product offering, from just leads and being a lead generation platform to having all of those business intelligence tool. And we see with the NextSphere acquisition, the ability to immediately sell to 43,000 vendors. And NextSphere has an average ARR per customer of $13,000. So the opportunity is huge. And already since we took NextSphere over in mid-October, we've been able to sell somewhere in the vicinity of 15 NextSphere subscriptions to those 120,000 vendors already. Before Christmas, we were going through the process of understanding the data and really looking into that. And now we've started to move the needle on the marketing initiative, and we're really pleased to see those sign-up numbers coming through. I'll quickly spin through the FY26 financials. So you got them on the board. Cash balance of 7.2 million, as we discussed earlier. We did a capital raise supported by a cornerstone by a US-based fund. So we've got $7.2 million cash in the bank at 31 December. We can see growth in the group ARR, etc. You can see this here, as I touched on. The enterprise ARR has been where we've been growing. We've kept the vendor ARR stable, and now we've got the NextSphere ARR coming through, and we can see that growth rate. NextSphere's growth rate historically has been at 25%. So if we can continue that, we've got a really strong growth story to tell. Quick look through at our P&L. We see FY26 as being an investment year. We're investing with the NextSphere acquisition. We're investing in AI. I'll just quickly bring some of that up. We touched on NextSphere there. We're investing in AI into the platform. So hopeful to release our first proof of concept POC 1 before 31 March. Second one will be done before the end of financial year, and then further 2 pieces of work before Q1 FY27. Felix has a really good use case to leverage itself to AI. We've got a lot of proprietary data that's not publicly accessible that we're able to utilize through our AI engine to ensure that quote responses and transacting within the marketplace is able to be put through a health scorecard. So we know that customers aren't wasting each other's time with quotes that are below market expectations, or they don't have the specific safety or ticket requirements, and we can front load that at the start of the journey. So you can see there, I touched on some of that with the bid comparison. So you can look at different bids and evaluate them faster than ever. And that's trained on the fact that we have 10 years of proprietary data right there. We also have AI-assisted vendor pre-quals. So pre-qualifying for subcontractors and for contractors, so both sides of the marketplace, is particularly cumbersome, given you've got to have such a long response to all the different initiatives: modern slavery, ESG, safety, et cetera, et cetera. So the ability to, as I said, leverage all of the 10 plus years of information we have on that sits behind closed doors to ensure that admin is reduced will be a win for both our vendors and our organisations. Final point I want to make is we've got new chairman, Dominic O'Hanlon, who joined in January. There was an ASX announcement on that. And very recently, we announced that we have a new CEO joining 1 April. His name's Chris Atkin. He has a long and decorated career in software, over 25 years. He's had successful exits, and we're really excited for him to start. I might take a breath there, Andrew. Mark, I appreciate I've covered a lot, and there might be a whole list of questions after all of that.
Yeah, James, I think taking a breath is required for bloke who's doing 3 jobs at the minute: CEO, CFO, and corporate secretary. I'd say nobody's more excited for the new CEO to start than yourself.
Very much so.
Question in here. Enterprise customer acquisition slowed down in FY25. Was that due to, it says distractions, but the NextSphere acquisition, just taking a lot of focus, or cash constraints, or just where the broader, I guess, market is, and what is kind of the outlook on that enterprise customer growth or acquisition, moving into the next kind of 12-18 months?
Yeah, it's a really good question, and I think there's many sort of facets that went into it. I think the first one, and one of the biggest ones, is that I guess the buying process for our average customers is taking longer than ever, and that's just because organizations are testing and retesting business cases. The level of sign-offs, it seems to be quite considerable. So we're not necessarily losing deals per se. It's just that the time to go, I guess, to get an enterprise contract signed is longer than ever. And just like an anecdote on that one is that we have a organisation that we signed in February. Not a huge deal, about $170,000 per annum ARR, which is a bit more than our average. But that organisation, we got named the preferred in the first week of November 2025, and it sat in the sign-off and the approval route, had to get 7 signatures before we got effectively the signed contract in the start of February. So that just gives an example as to how businesses are operating in this environment. We're looking at initiatives to reduce that and be proactive. We've spoken about our land and expand strategy, so getting in at smaller use cases, the project level, to be able to go outside of the large corporate DOAs and levels of sign-offs. But it's just an element to note. The other element is that we ran a 3-year strategy to focus on the cost base, get to cash flow break even. And I think the trade-off to that was investment in the platform, and was probably not at the pace that it had historically been at for Felix. And I think what has resulted from that is the fact that, things like AI, where we would love to have been 12 months more progressed in our AI strategy than now, but you obviously need to say no to things to progress the cost base and ensure that we were getting to cash flow break even. So we've done that. We've done the capital raise, and now we're deploying that capital through the AI strategy, and also through some other improvements like the contracts module and other bits and pieces around the platform and Nextsphere integration.
In terms of competitors to Felix, who would be your main competitors, or is it people running a system where it's a couple of disparate systems, a bit of what SAP can do, a bit of other 1 or 2 standalone softwares where it's not one system, but you can do with APIs and stuff internally, or you just have people working across 2 or 3 systems, but it still kind of gets the job done?
Yeah, I think it's a good point. Like just on our sort of what we replace and what's sort of like for like with us, we're probably seeing in the market, we're seeing less sort of paper and form based through the passage of time, and we're seeing more of the third column there, the point solutions. So I think we've seen a lot of commentary around AI and SaaS companies and how defensible that are they to AI attacks. We don't, we're lucky in the sense that the platform is broad and has a considerable amount of depth and breadth to it. It's got a lot of large proprietary data, and it's a network offering. So that means that sort of these AI-led point solutions are able to sort of impact a very skinny part of the platform, but it's not like we see ourselves getting challenged and losing out to deals by someone who's vibe coded a Felix copy and, oh great, I've replaced I can rip Felix out, I can put in this AI bot thing that I've coded up. That's not the case. What we see is a particular part of the workflow might be impacted, but not necessarily the whole solution from a competitive landscaping environment.
I know you touched that there, the Nexia deal, the cross sell that can kind of happen there with the vendor marketplace. With 126,000 kind of vendors on the platform, and I appreciate some of them might not be active, and there's a bit of natural churn, things going out of business, new ones coming on. But I mean, is there scope to grow that vendor marketplace? I mean, 126,000 right across the industry. I mean, is that kind of anybody who deals with your major end clients, the Simics and John Hollands of the world? Is that kind of, have you kind of captured that whole market? Everybody who wants to work with those are basically on the system.
Yeah, I think the size of that marketplace, there's still each contractor that we sign up in Australia, there's less and less new vendors who are joining that vendor marketplace because we've captured more and more of the critical scale. But what I think our challenge is, and what we're focused on, is what number of those 120,000 can we can we, sell to right now, and what are the internal bottlenecks that we've inherited from the acquisition of NextVia to go from their sort of level of new signups to what we want to do in terms of, we want all of those 120,000 vendors paying us yesterday, and what are the internal limitations to that, and what do we need to do to ensure that that business is set up for scale. So I think, growing, it's always going to be good, but at the same time, I'd like to see how do we sign up more people faster to actually paying.
And just on the, you talked about a lot of the businesses you work with in Australia have got the international parents. Is there no, in the revenue model, no kind of project fee per se? So, I'm just thinking, are some of these international guys kind of, signing it up in the Australian business for a project they're working on here, but, then utilizing it then for projects kind of all over the globe. So just from is there a way to capture a model fee as well as a software license fee across the whole system?
Yeah, it's very good point you raise, and we've tried to contract that into the sort of pilot contract initially, and always creates a friction point because
I can
then
imagine
if they contract, then they think in for a penny, in for a pound, etc. So it's a delicate dance, but it is something like, for example, that Middle East contractor. I appreciate that, that region's got its challenges at the moment, but we signed them up last half, and that's very much they have a European parent, and it's very much viewed as a trial for the global operations. So that's exciting, really exciting for us.
Okay, James, unfortunately we're out of time, but yeah, thanks for coming in and giving us an update. It's been a good few years since we've heard the Felix story here, and yeah, maybe we can get the new CEO in a later stage in 2026 once he's settled into the hot seat there.
Awesome. Thanks very much for that, Mark. Appreciate it.
Thanks, James. And we will now hand over to our third presenter of the morning, fresh from I don't know, he was overseas. He can confirm where he was. Hopefully he wasn't rerouting through the Middle East to get back to Melbourne. Try Mortleman from GALE Pacific.
Thank you, Mark. Yes, good to be back with the Coffee Microcaps platform. But no, I was coming back through the United States. So
okay,
thankfully, right.
We didn't have to reschedule it then.
No, which was helpful. So hopefully, it's just
it's just loading now. Troy, I will
loading.
Nod. Yep, I can see the cover slide now. Troy, you can take it away whenever you're ready.
Excellent. All right. Thanks, Mark. And yeah, good afternoon, everybody. It's just ticked over to afternoon. So yeah, my name's Troy Mortleman. I'm the CEO of GALE Pacific. So what we'll sort of do today, I think, is go through a few things. We'll go through a snapshot of who we are as GALE Pacific. Then we'll go through our strategy, and then some of the achievements that we've done in the first half, in particular. Then go through the financial performance, both as an overall group and also by our operating regions. And then we'll highlight exactly what we're working on right now as we head into the second half and what the outlook is for the remainder of the year. 2026 represents 75 years of this company, and we've been in technical textiles and shade innovation throughout that whole period of time, and we've really applied that engineered performance to real world applications right across the globe in all sorts of different end markets. And so that heritage has really underpinned our credibility across the market in those markets that we operate in, but also we've been able to adapt naturally as conditions change, as they are right now. We are a vertically integrated business. We've got manufacturing and global distribution that allows us to completely control quality, to manage the complexity, and to respond really quickly to changing market conditions right across the world. We operate across multiple segments. So we're in consumer segments, we're in commercial segments, we're also in industrial as well. So that gives us a level of diversification by channel. But we're really sort of focused on that shade category where we've got a level of really deep expertise. Our products are really fortunate to be ranged in some of the world's largest retailers. So these are retailers like Bunnings here in Australia, but in the United States, Lowe's and the Home Depot, which have 3,000 stores right across the United States, Canada, and also in Mexico as well. And we're also being increasingly specified in those commercial and industrial segments where the technical performance of our product and the longevity and the value that it creates to the ultimate end user is something that that people are really valuing and have done for a long, long time. We're also a pioneer in closed loop recycling in particular. And so we're extending that capability right across our product portfolio. And so where we're using and getting those products at end of life, putting them, recycling them back into pelletized resin and putting them back into our supply chain, which is really world first technology that we're pioneering right here in Australia and now adopting right across our manufacturing footprint, right across the globe. So we'll touch on what we're doing from a strategy point of view, and then also the progress that we're making on some of those really key priorities that we've got. So look, over the last sort of 6 to 8 months, what we've done is we've sharpened our strategic direction as an organisation. So, and with the main aim there, and the only aim on that is to support sustainable growth and to deliver improved returns. That's why we're doing this. So where we've elected to anchor our future growth strategy of this company is in and around that shade category. And this is a category that GALE Pacific has really deep expertise, and it's one that we exist and operate in all of the 40 markets around the world where we transact. Our technical performance, though, in our fabrics in particular that we've made over that period of time, has given us a really strong market position in all of those markets we participate in. But the next phase of growth is about moving just beyond selling shade products. But what we want to be able to do is provide complete shade solutions. So what this will mean is that we need to be able to leverage insights from the market, whether it be for consumers and also in commercial markets, and then translating those into really meaningful innovation. So whether that's through product development and new products that we do, or whether that's how people purchase those products as well, and making sure that they get the right information right from that search, research, and then ultimately purchase, and then going on into maintenance and installation. We've now got a very clearly defined purpose as an organisation, which is to enrich lives through shade, which is a great purpose for us that drives us. It does fuel us to achieve what is our ultimate vision for this company, is to make shade as fundamental to outdoor life as sunlight. And so what this does now is it provides the organisation about clarity about where we're focused and a unified direction of how we're going to grow. Now, how we're activating in terms of our activity across that strategy is across really 3 key pillars. The first one is about culture. Maintaining a really strong safety record is important. High employee engagement right across the group, and particularly a continuous improvement mindset to be continuing looking to ways to do things better, faster, and more cost efficient. The second one is about innovation. This business has always been very, very strong in innovation, but it's about making sure that we're end user driven and that we're solution focused in our innovation, and that we position the brands that we have, both Coolaroo and also GALE Commercial, as the first choice in their given markets. And then the third one, of course, is growth. This business needs to grow, and that's our ambition. So it's about expanding channels in the existing markets that we play in particular across the United States, Australia, and our base in the Middle East. Also establishing new product and digital partnerships to be able to enable us to get to more customers more effectively. And then looking for different climate appropriate regions where the products that we have and the solutions that we provide offer a real level of clear value. And then, of course, naturally, driving operational efficiency and delivering sustainable profits is absolutely central to everything that we're doing. So financially, how are we going to measure that success? Well, it's about really 3 key outcomes. It's about expanding margins, it's about growing EBITDA and improving free cash flow. That's exactly what we're focused on. We've embedded this strategy now throughout the organisation since we launched it in the back half of H1. And as I said, it just now provides that clarity for us about where we play, how we win, where importantly do we allocate capital and where do we invest, and where do we focus our attention as a leadership team on being able to achieve that growth. And so I think that the work that we've done across the first half, across some of those things around some of the decisive actions that we've taken, sort of start to exemplify how we're really living that strategy throughout the organisation. So at the full year results for FY25, which was in August, we highlighted a couple of key strategic priorities that we were focusing on for the first half, and so we've made some really solid progress across both of those key things. The first one is talking about what we're doing in the United States and our Americas operating model. So we've completed a 24% reduction in overall headcount in that marketplace, and really we're focused on streamlining administration and management roles. So what this has then allowed us to be able to do is sort of simplify the operating structure, naturally reduce overheads, and importantly improve decision-making speed by removing some of that complexity. So those actions are really starting to deliver tangible results, and we've got $3.1 million worth of cash savings expected for FY26, and what that'll do from a recurring point of view on an annualized basis is $3.7 million worth of benefits. And so it doesn't stop there. Naturally, we're looking for and actively working on other ways that we can make sure that we can really remain agile and responsive in what is still a fairly challenging market, particularly on the consumer side of our business. The other one is around manufacturing diversification. And so we have our facility there up in China, and we're looking at ways of where we can de-risk that and diversify our manufacturing footprint outside of China. And so we've made some really significant milestones that we've passed along the way. So at the end of the first half, we successfully piloted fabric production in Thailand. This is for our roller shade products that we sell predominantly in the United States. And now we're actively working with that same partner in Thailand to be able to look at assembly trials as well. And we'll continue to progress that as we go through calendar year 2026. And so these things do a number of things that naturally sort of mitigates a bit of risk as it relates to US tariffs, albeit tariffs are relatively parity in a lot of cases now around the world, but we know that there's higher risk in terms of China in particular. But it also means that we can diversify that manufacturing so that we manufacture in two places across the world and improve our supply chain resilience. The good thing is that our US customers are responding really positively to what we're doing. They're giving us the time to be able to do that. They understand that this is a really complex change, and our goal then naturally is to make sure that we deliver the same product at the same level of quality that our customers have come to expect over that time, and particularly our end users. And so we want to make sure we get that right. So we're methodically working through that. We're making some very, very good progress, and we'll continue to update everybody as we have more key material updates to be able to provide. The other key thing that we did across the first half is to launch a new website platform as well across the brands that we participate in, and so this is really an enabler for us to be able to deliver those complete shade solutions. And so these digital platforms that we've invested in to allow us to do that. So on the left-hand side is our refreshed Coolaroo website, and so this is our consumer website, and this is now a globally harmonised website for our Coolaroo brand. We had disparate websites across different markets. We've now got one platform right across the world. We've introduced e-commerce capability into that platform as well, and particularly driving that through the United States. And so that gives us our consumers another avenue to be able to purchase our products. But importantly now it provides a platform that we can have enhanced content for that research, search, and selection process for shade products, and then also just guide them through all the way right through into purchase. So we went live just before the end of the calendar year 2025 in the United States, going live here in Australia now that we're coming out of our peak trading period across the summer, and now that's live right across the group. On the right-hand side is what we're doing for our commercial brand. So commercially, this is where this business really started from, and our customers use that resource to be able to find exactly the right product for whatever application that they're looking for. And so now we've got a harmonised GALE commercial platform, and it gives a really clear, distinct identity for our commercial brand. So What this will do is give us the ability for enhanced technical content, detailed product specifications, and particularly application guidance for the fabrics that we have that have a wide range of applications across different segments. And we are going to be able to steer our end-use customers through into that. It's also about case studies and highlighting the things and the markets that we participate here in our home market of Australia, where we're delivering really key value to our customers, and being able to highlight the key functional and financial benefits that product delivers, so that we can then replicate that across our other markets, particularly in the United States and also into the Middle East as well. We'll also be able to connect our customers to end users as well. So we've got a really broad subset of commercial fabricators that we work with and who use our products, and so connecting them with the ultimate end users and providing that level of connection is another avenue that we'll be able to explore using this new website. So now we'll just go through our financial results for the first half in particular. So look, group revenue for the half was at $82 million. This was down 9.5% on the prior period. So a couple of factors that went into that. It's a combination of softer retail demand in the Americas in particular, and also a more disciplined retail inventory fulfillment model that we've implemented, which I'll talk to, and also really mixed seasonal conditions across our regions. Our EBITDA was at $5.3 million, which was ahead of the guidance that we provided of $4 million at the AGM, and it was marginally lower than the prior period. So despite that impact of that lower revenue in the period, it does reflect that we're tightly managing costs across the group, and that also reflects the absence of costs associated with the implementation of our ERP system, D365, in the prior period, but also reflecting early benefits of that US operating model reset as well. The net loss after tax was at $3.3 million, but it's important to note there that out of that, almost half of that loss after tax was around the non-recognition of US tax losses as a deferred tax asset, as opposed to anything from an underlying trading performance. But where we've really taken a really clear step forward is in cash. And so net cash was at $15.1 million, which was, again, driven by disciplined inventory management and improved working capital outcomes, particularly in the United States. So where we've really tightly managed and changed the way that we fill our retailers with inventory going into their peak season, and we're electing to do that and shift that more closer to when it gets warmer, as opposed to doing that through the winter months, and that's really helped us. And what that's been able to for us to achieve is that we moved the group into a net cash position at the end of the first half of $1.9 million, compared to net debt, which was $8.9 million at the end of the first half of FY25. And so that shift has been more about the deliberate management actions that we've taken, as opposed to any sort of particular changes in market conditions, which is really pleasing as a result of the work that we've done. So we sort of go looking at our regions. We'll start with Australia and New Zealand. And so grain storage fabrics really exceeded our expectations, although they were lower than the prior year, where we had a very strong replenishment cycle. Customer demand did remain solid throughout that period. Bunnings in particular, it was modestly lower than the prior year, which was really driven by unfavourable weather conditions that we experienced in December, with cooler and wetter conditions, particularly in the south of the country. But we did have better margin mix coming through, also more disciplined cost control that really impacted and supported profitability throughout the region as well. And we secured a long-term contract manufacturing contract as well with the major commercial customer that'll help us to drive earnings in our home market. In the Americas, retail conditions remain really challenging. Consumer demand was soft coming off the back of the end of our peak season in particular. But then, as I said, we've also changed the way that we fulfill that inventory. So around about half of that revenue decline in the Americas was due to that sort of shift of that revenue and changing of the timing of when we do that. in particular. One thing to note, though, is that our commercial business is pretty resilient at the moment in the United States, despite some challenging conditions when it comes to related construction materials that go along into the projects that our products participate in. But the commercial business is pretty resilient there as well. And of course, we're now starting to see some of the benefits of that operating model reset start to flow through into earnings as well. Our developing markets was really a story of the Middle East in particular. We know the conflict that's happening there at the moment, but that had started to impact that region, particularly as we exited the end of the first half. And so that was quite challenging there. Our business in Europe, though, was quite strong, and we saw growth in our markets, particularly across Spain and Italy as well, that started to offset that. So still growth in that region, but not as much as what we would have as much as what we would have thought. On the cost side, we certainly did reduce costs by $2.4 million compared to the prior period, which was the absence of some of those costs that we incurred last year. And then FX was more about just balance sheet and non-cash revaluation of revaluations across that sort of US and Chinese currency. So look, they're really, despite some of the challenging conditions, it's about stronger operational discipline that's delivering better results for us, improved cash, which is the most important thing, and just some of the impacts of some of those structural changes that we're making. And just finally, I'll touch on is just our key priorities and what we're working on as we are now into the second half and what we're looking at. It's really clear that our focus is what our focus is. It's about execution. In North America, we're about to enter into a peak season, and we're looking at maximising our performance in the Americas, particularly in the consumer part of the business, and what we can do to protect margins in those spaces in particular. Right across the group, we continue to build on those efficiency gains that we've done by continuing to look for ways that we can simplify our operating model and to remove duplication and waste. Our manufacturing diversification platform is still a really clear priority for us, and we'll continue to do that whilst we're optimizing the China cost base that we have in manufacturing. And so that way we can do both of those things at the same time. But importantly now, we're really focusing our attention on growth. We're ramping up growth initiatives that are aligned with our strategy, and both across our consumer and also our commercial markets right across the group, right across our 3 operating regions as well. So look, from an outlook perspective, Australian retail trading did finish the summer pretty strong. January was a great month for us, whilst December was a bit quiet. From a weather point of view, January was the opposite, and we actually had record sell-through our Bunnings business in the month of January. In the United States, we're remaining pretty realistic in our outlook there with the United States. We know that the impact of higher petrol prices and gas prices in the United States is impacting consumer confidence there, but we're seeing some encouraging signs going into the start of our peak trading period over spring and summer, and also that commercial business remains still pretty resilient in the United States. Our developing markets, again, becomes a story of the Middle East. That region is naturally quite volatile at the moment, and so that's going to remain challenging for us as we continue through the second half as well. But importantly, we'll start to continue to see the cost benefits of the work that we have done again start to ramp up as we get into the second half as well. So look, early signs from our customers about some of the work that we are doing on those growth initiatives is really encouraging, particularly in the United States, where they're responding quite strongly to what we're working with them on, and we'll look forward to giving further updates on that as we go. And so, of course, naturally, given the challenging conditions in the world at the moment, we're just electing not to give any level of full year performance guidance at this stage, and we'll update the market when we get more information. So with that, I think I'm at 22. So I'll happy to answer any questions. Thanks, Mark.
Thanks, Troy. In terms of I just want to touch on the Thailand manufacturing business, if I can.
Yep.
Does that also feed into improving the EBITDA margin as well? Because as we know, over the last kind of 20 years, China was a very cheap place to manufacture, not so much anymore. So aside from having another manufacturer and giving yourself a bit of diversification, does that also feed into improving margins in terms of you getting a slightly better price point in Thailand versus China?
Yeah, probably it's still a little bit early for us to say because we're still proving out that business case where we're working with partners who haven't done the assembly part of it. Our partners are manufacturing fabric, but the assembly part of it we're still working through. So we don't expect it to be worse than where we are in China, but naturally we've built up a level of efficiency over many years of making those products. But we want to make sure that that we remain cost competitive and protect those margins at all possible costs. So we think we've got a pretty good chance with the trusted partner that we've been working with for many years to be able to maintain margins.
Okay. And then if we focus then a bit further up the income statement, revenue growth, do you see a bigger opportunity in the commercial space to drive that revenue growth, or is it changes you're making on the Coolaroo kind of retail consumer basis? I'm just trying to understand where the biggest opportunity for the revenue growth piece is going to come from.
It's unsurprisingly, it's both is where we're really focusing on. I think the footprint that we have in our retail business, particularly in the United States, gives us a great platform to grow, where we're on the shelf all day, every day at over 3,000 locations right across America in Lowe's and Home Depot. But we're only in one category. And so our expansion or our opportunity then is to expand that across adjacent categories where we participate at Bunnings, and we're actively working on those opportunities at the moment. Even in a trial phase in those retailers with 10 times the store count, we can get a really material injection through the trial of some of those products as well. But on the commercial side, it's exactly the same story, where our commercial business right around the world, actually outside of Australia, is just in architectural shade. But we do have a lot of horticulture products that we have great expertise here in Australia. And so we're actively working with customers in the Middle East, where food security is really important and has been and is even now more important, but also naturally in the United States as well, where they have exactly the same growing conditions across wheat and wheat harvesting, and also fruit as well. Greenhouses, hothouses, those things that we operate here in Australia, and we can see growth opportunities in both of those things. We're actively putting a little bit more emphasis on our commercial business at the moment. It's our higher margin category that we have, and we're deploying additional sales resources, particularly in the United States, to go after some of those agriculture and horticulture markets. And that's where I was just in the United States just in the last couple of weeks, talking to customers in Arizona and in Southern California about some of those opportunities, and it's encouraging to see the early engagement from some of those customers on what we're talking to them about.
If we have you back in here in 3 years' time, and a lot of this is kind of played out by then. I mean, what should we kind of think of as would you see as a sustainable margin? Whether that's at the impact level, EBITDA level, once all this strategy comes together, what should people be thinking about as, somewhere in this ballpark is kind of, where you think it's all going to kind of coalesce around?
Yeah, look, the numbers that we're really focusing on is those 20% EBITDA margins. That's really then when we get to those levels, we know that we can do lots of things to be able to scale the business, and that's what we're really focused on, is getting to those levels with this strategy in particular. And we think we've got a great opportunity to be able to do that. We'll have an operating model that will be efficient, that allows us still to be able to scale and to be able to drive revenue growth in particular, because that's how we get there, is through revenue growth in some of these core markets that we participate in without layering in additional costs. And so that's the work that we've really done over the last 12 to 18 months, and particularly the last 12 months, is to look at that operating model and get it as efficient as possible. But now casting our eyes right around the world to those growth initiatives, but still being really targeted at offering and how we deliver value in that core market of shade. So they're sort of the numbers that we're focusing on.
like Australia, it's taking the retail products from Australia, putting them into the US, and also the commercial products, horticulture, also taking that to the US. In terms of other product development, is there anything in the works where there's a potentially new line, or moving into an industry that you mightn't think would take up a lot of shade, but you think there's an opportunity there? Is that part of the revenue growth story maybe as well?
Yeah, it's probably a two-stage approach on innovation. Really, it's all about being end user focused, and how do we connect our products more with end users and the people who get the benefit out of that, whether that be both in consumer or in commercial space. We've often just provided the product and let someone else turn that into a usable product that they can go out and be installed in backyards, all over Australia and the United States. And so we're doing a little bit more on that innovation front to make it easier for people who aren't as familiar with shade, primarily in the United States, who want it but don't know where to go, and to be able to look at innovation broader than just the fabric, and working with partners to be able to do that, to make it more accessible and more intuitive for people to select that shade. On the commercial side, we're continuing our advancement around sustainability. And we're working again with another federal government grant to be able to get more closed loop recycling and more recycled resin back into our raw materials to increase that level of content, which again provides not only a sustainability benefit but also a margin benefit, as well as we recycle resin at a much lower cost than what virgin resin is, particularly when you start thinking about the impacts of oil and the like as the base material for a lot of resin. So we're looking at it both ways, but our innovation will be really fueled by how we can make it easier for customers to access and to be able to use our products, as opposed to any other level of innovation that we may have done in the past.
Perfect. Troy, we are exactly on time. Thank you very much for joining us post jet lag. Very much appreciated. And maybe we can catch up again after the second half, and a few more of these initiatives will have had time to play out.
Yep, definitely. Thanks, Mark. Looking forward to it.
Thanks, Troy. And then, as the old saying goes, start as you mean to go on. We started in Perth, so we're going to go back to Perth now to be joined by Sam Budiselik from Cash Converters. Sam, good morning.
Hi, Mark. How you going?
I know Troy said good afternoon there, but we're going back to the morning for you there in Perth.
I'm actually in Sydney today, so I'll take time check.
You've just completely blown my whole intro there now, Sam. But anyway, if you want to bring up your deck, Sam, I will let you know once it's on screen here.
Yep. Give me a sec. Sorry. Sorry, one sec. Here we go.
Okay, that's loading now, Sam. I can see the cover slide now, Sam. You can take it away whenever you're ready.
Thanks, Mark. Good to see you again, Mark. I think we've had a busy few months since we last spoke, so excited to catch up again. I thought I might just go back to the start, just to give a brief overview of Cashies and the network and the modern business, just as a quick refresher for those joining the story more recently. I'll just jump through our half-year presentation just to the global store network slide. Look, Cashies, we've traditionally run a retail buy-sell store network, and in more recent times developed a personal lending business. And I think both of those pillars of our business model have changed significantly in recent times. And I'll talk a little bit about that, significant transformation in a minute. I guess a way for me to sort of start thinking about describing our business as our store network and our corporate store numbers. So traditionally we grew through a franchising model. We started in Australia growing out to about 150 stores that were predominantly franchised, and about 200 stores in the UK that were predominantly franchised. In Australia, UK, and New Zealand, we're operating as a master franchisor. And in those jurisdictions, we then started acquiring the franchise stores and making them corporate stores. And the orange bubbles there show the current corporate store numbers. So 121 in Australia and 65 in the UK is really where we're focused our attention. And I think our store network is undergoing a bit of a change as well in terms of the size and shape of the stores. Are very much a luxury inventory focus through our stores, and I'll talk a little bit about that in a minute. But we're very focused in our strategy of not only acquiring the franchise stores, those blue bubbles there are really opportunities to continue growing our corporate store network through franchise acquisition, but we're also growing those networks. And we think we could probably add another 50 or so stores in Australia where we've identified sites where that would make sense and we can reach some new customers. And we've made some acquisitions on the eastern seaboard in particular that allows us to, move into areas where we're underrepresented, particularly in New South Wales, up towards Queensland. And in the UK, we think there's a huge opportunity over in the UK to add more stores. We possibly even double that number over time when we look at territories and sites where we could operate. But we're steadily sort of balancing, acquiring stores and opening greenfield stores. In Australia, we might be acquiring 5 a year and franchise stores a year and opening 5 a year, something like that. Greenfields, corporate stores. And then in the UK, it's probably 10 of each, maybe acquire 10 stores in a year and open 10 stores, something like that. And in the rest of the world, we do have in place, which we've licensed out, not so material to corporate, but through Europe, South Africa, parts of Asia as well. I'll just go back to just a bit of a summary of the transformation of the business. So Cashies has probably always been recognised as that second-hand retailer with a bit of pawnbroking. We've introduced personal finance into the business probably in mid-2000s, and then the business was really positioned around offering what's referred to in the media as a payday loan. That was a sub $2,000 loan product. Centrelink customers could borrow that product and regulated under the Credit Act, but it brought some political and reg risk with it as a function of that customer cohort. I think having exited that business in the late part of the calendar year last year, and we've sort of taken 4 loan products down just to a simple Cashies loan off and now simple unsecured personal loan product. It's really changed the profile of the lending business in a big way. So where we had the traditional loan book probably more focused in the 300 to 400 credit score range with some Centrelink borrowers in the book. Now the new product is solely focused on gainfully employed borrowers, credit scores towards 600. We're sitting more at the top end of the subprime spectrum when we're lending now. The loan product, it's lower rate. It has some more flexibility for the customer. It's a different customer cohort predominantly that we're now servicing than we were in the past. We have taken some of the higher credit quality customers across into that new loan book, but big pivot of that loan book has been significant. It's led to this chart on the right. You can see declining loss rates in the loan book as the credit quality's improved. And you can just see the composition of that loan book changing down the bottom there as the old books are running off and the new loan books growing. And I think a significant driver for doing that is that as a function of offering a payday loan product, it's a small amount of credit contract under the National Credit Act, was that the perceived social risk and political risk and reg risk with that product meant that the banks didn't have the appetite to fund our business. And by exiting that loan product, we now have the potential to engage in much better funding conversations and a much better funding cost and structure profile for our business. So that's an exciting lever we'll talk about strategically. But to engineer that significant change in the lending business, we've had to embark on a store acquisition program and probably a refocus on optimizing our store network. The chart on the left showing the blue element of the bar chart there is exciting for us as we deliberately set about really establishing that UK network we spoke about before. So, predominantly the UK contributing to that revenue number, 34% of revenue. It's a similar contribution to EBITDA now out of the UK. And we're bullish on our growth prospects over there, as we do have some bank funding available with Lloyds Bank to continue the acquisition program that we've started in the UK. And I think that points to where we're sort of heading in the Australian business too, as we look at our funding options and a refinance of our funding facilities, which we'll talk about in a minute. And we're trying to do this in a way where we do continue our earnings momentum. And you see that center chart showing, reasonable earnings trend and growth, considering what's happening under the hood of the business and the significant change that we're engineering. So by continuing to grow the new loan book, and early days when you're growing a new loan book, there is a bit of an earnings drag as you're providing up front for expected losses, and acquiring these other stores. We've managed to continue that earnings momentum, which has been terrific to see. So, back to the strategy summary. I'll just sort of try and wrap that up. Yes, we still operate a store network of 150 stores in Australia and 200 in the UK. We are online too. We believe in our store network. It really helps us reach our customers in local communities, and it engages us in a way that's quite different to, an online-only business. Our online retail is growing. It's sort of heading up towards 20% of our retail sales now, and all of our inventory that we're buying in a store is available online to purchase from anywhere, either in the UK or Australia or in each of those countries. And we offer our lending business online and through stores. So, it is a pure omni-channel model. It does work. It's symbiotic in terms of how we can reach customers. Often a customer might start a retail purchase journey online. If it's a higher value item, going to store, and it works well like that. But simply put, we've really shifted our lending business in a different direction. Really lifted the credit from lower levels, sort of 300-400s to 500-600s, and it sits nicely now, I think, placed in terms of lower loss rates and a different customer cohort that we're dealing with, generating a very different kind of business. And like I said, ultimately a refinance of the business down the track is what should result from that. We do continue acquiring franchise stores too. It's been very successful for us. The acquisitions are earnings accretive day one. The stores have been operating for a long time. We've gotten very sort of sophisticated in how we're valuing the stores, and buying a couple of units and then starting to buy bigger networks, proven out our forecasting and our modeling. We have good confidence that, when we're looking at the revenue income from those stores and putting a corporate overlay on those stores, and then valuing it something like 3.5 to 4.5 times, when we're folding those stores into our corporate network, generally we're outperforming our forecasts as we're putting a bit more capital into those stores. This is the same strategy in Australia and the UK. It's exactly the same. So as we fund the businesses and get the momentum going behind those businesses, we achieve a good outcome. And they're bridging, like I was saying, that transition to the lending book in terms of a consolidated earnings position. So in the segment half, in the half result at a segment level, you do see the Australian store operation really starting to contribute more now at an EBITDA level, and the UK segment contribution growing quite significantly, and the personal finance numbers dipping as the transition's happening. And then we expect that personal finance, that new loan book, that new cashies loan book, to return to growth, and that will start contributing to earnings. And both of those, parts of the business growing will be good overall. Just in terms of the store network, it is a very different sort of look and feel these days to possibly the past, where people have been into a store. We've just opened a second luxury-only store in Adelaide to complement the Bondi store in New South Wales. And we have a number of these stores planned in each of the capital cities, and we should see a majority open by the end of the financial year. But the purpose of these stores, it's really a flagship store to show that we're dealing in a different sort of customer and inventory mix in a city. And I think as people are coming in and seeing, luxury handbags and trainers and the high-end watches and jewelry in these stores, it generates that thought. We're moving into that consumer sort of thought process about possibly liquidating some of the inventory that they have at home that people don't necessarily want to go and sell on eBay and deal with those safety and security concerns that you might have selling online. And I think purchasing higher value, pre-owned items, you want the confidence that you're buying authentic material, and that if you have any issue, you've got recourse to the seller, whereas you don't always have that opportunity online. It's not so simple. So, leveraging technology to be able to authenticate handbags and shoes has really opened up a new revenue line for us in the stores. And the general inventory that we're buying, if it's too much to sell back through this store, we're putting out to the other stores around. That then generates a similar sort of inventory flow into those stores. So this is a very important initiative for us. We've opened one luxury-only store in the UK, and we see that continuing. And this program then provides a subset. In Australia, it'll be 5 to 7 stores probably in the total store mix. It's an exciting development. The stores in general are trading really well when you look at the numbers, and I think PBT year on year, we're talking significant increases, 30% in Oz and maybe 90% in the UK, part driven by acquisitions, but also part driven by better discipline around the turn of the inventory in the stores. We've got really good management reporting in place. We've obviously got the impact of gold flowing through the business. So, about half of our inventory is jewelry. And about a quarter of the total, or a half of that half, is gold. So we do buy gold. We've always bought gold. We've always sold a lot of gold jewelry. And I think with the price increases, it's just a natural, it's a benefit to the business. It's interesting. There are new customers coming in looking to monetize any gold they've got. We don't really take a long-term position on it. We'll either retail it or scrap it if it's broken or damaged and liquidate it. But that's been a nice tailwind in the store network for us. So, Mike, just conscious of time and allowing some time for some questions, I'll just finish on a bit of a snapshot of our financials. So, traditionally, we were fairly heavily personal finance focused. As we've mentioned, we've rebalanced a bit. The store network's contributing a bit more, and finance has come back a bit as we're transitioning. But with both of those segments growing, we're seeing pretty good underlying revenue and earnings growth. The UK now contributes about 30% of our group EBITDA. So as a master franchisor, we're probably generating about £1 million of EBITDA a few years ago in the UK. We're seeing that growing towards sort of £6 million through the numbers. As we start adding, more stores with that Lloyd support, we see a pathway, that keeps growing. And in sterling terms, that becomes quite material in Aussie dollar terms. At a consolidated level, the business, it does about 400 mil a year of revenue, about 75 of EBITDA, and about sort of 22 of net profit at the moment, which has enabled us to continue acquiring using some cash, the franchise stores. We've raised a little bit through an equity issue, so we can balance continuing to pay the 2-cent annual dividend that we've been paying for the last 5 or 6 years, and continuing that strategic momentum of franchise store acquisitions and loan book growth. And our cash, the business generates pretty strong free cash. And, as that runs up, considering the cash that is restricted in the lending facility of, circa $15 million, we have a pretty good capability to continue acquiring those franchise stores and growing our loan books. So in summary, the big levers, the franchise store acquisitions continue in Australia and the UK. The new loan book continues growing, and we look at our balance sheet and our funding facilities, and off the back of the strategic shift in the lending business, options and cost reductions on our finance and better flexibility to leverage our balance sheet and continue this strategy. The only point I'd finish with, Mark, is that in Europe, whilst we've licensed out our business model, in Spain, in Belgium, in France in particular, big, strong store networks, Spain has 100 odd stores. France has about 60. Belgium has 40. There's a pretty good operation running over there. Our partners operate it. We don't really have much to do with it beyond just supporting those businesses with any sort of ideas and insights into markets. But I think over time there could be some optionality to sort of take that franchise store acquisition strategy in Australia and the UK and widen it, and to really build out a European business. And we take that UK contribution to EBITDA of around 30%. We can really grow that into a bigger EBITDA. So that's quite exciting. With that, Mark, I'll take a breath and open up to some questions, hopefully.
Yeah, thanks, Sam. And I just want to mention, while Sam was presenting there, I just put in the chat there, RAS Researchers, people will know from being a previous sponsor of ours, they've released an updated research report, which is available on their website. I put it in the chat for people who are here live, but if you're watching us back on YouTube, please check out the RAS Research, and their latest report on cash converters is up and available there. Just on the dividends, I want to just quickly touch on that, given the big franking balance. There was a period where Cashies wasn't paying a dividend. It came back in I think the back end of COVID, I think 21 maybe. It's been consistently at that kind of 2 cents, but as profitability improves, the big franking balance is there. I'm just trying to get a sense of what the board's view is on dividends, whether it's a percentage of NPAT or kind of payout ratios, or what kind of the policy is, given the profitability has been growing, but the dividend you've kind of kept it at 2 cents.
Yeah, good question, Mark. Look, I think we're a business that's fortunate to have quite a pipeline of what I would describe as low risk, earnings accretive acquisition opportunities in the franchise store network opportunity. So what we're trying to do is balance the lending business shift to bring us into some lower cost, better funding in Australia, and grow earnings by acquiring the franchise store networks. And also defranchising brings other benefits. Obviously, we can become a bit more nimble on product development and marketing, etc. So I think at a board level, what we sort of think about with the capital allocation is the traditional stack. You line up the opportunities and calculate the IRRs, and then sort of think about on top of that strategically where we want to get to with the business. I do think the business generates strong free cash, and it has. I think reducing the risk profile of the business is a big move, and it'll take another year sort of for that to fully wash through as the loan books run off and transition. And I think then a bigger growing business that's lower risk, it leads to the EPS growth that we're forecasting, that then gives the board the opportunity to consider, to your point, that release of those franking credits, that balance on the balance sheet would be great to think about options around the dividend and how we might do that. But I do think, for the next couple of years, we've got a really good pipeline to go after and invest in the future growth profile that we can see, integrate those stores, get that new loan book growing, and then really, sit back and let everything consolidate, and then consider options around the capital return to shareholders.
Yeah, perfect. We've got a question here about, obviously we had the RBA raising rates earlier in the week. So yeah, maybe just touch on, we've moved back now into an interest rate environment, and how, that feeds into, your borrowing costs, the loan book, adjustments to the credit model. Just touch on that now that we're in a kind of a different interest rate environment than we were even 6-7 months ago.
Yeah, interest rates are certainly a factor, but I guess indirectly it's more cost of living has more of an impact on our customers. So elevated fuel prices, groceries, communications, those sort of things, possibly rent to, more of our customers would rent than be mortgage holders necessarily. So on the demand side, I think we had pretty strong demand. If anything, that increases a bit as cost of living continues to be an issue for people. On the lending side, and in terms of arrears and loan book performance, it's the unemployment rate that we're looking at closely. It's remained very strong. Employment still, high. I think when we look at the provisions, we do put overlays on a scenario of a deterioration of employment. But the nature of our customers too, if you think sort of generally tradies and hospitality and, restaurant, tourism, the sectors that people are working in where they might have casual employment, they're a bit more fluid in terms of how they're finding work. We're not seeing anything in the early stages with anything around first payment defaults or DDR dishonors or vintage curve deterioration. And, our book's stratified over a lot of little loans with a lot of different people in different industries, in different states. It's probably a bit different to the mortgage thinking with the banks about the impact of AI on white collar employment and possible arrears spikes in a mortgage book. We don't look at it like that. But yeah, I guess in summary, we're seeing good demand. We're seeing demand growing both in the lending business but also in the retail part of the business. Anecdotally, if you're looking for something and you're a bit cost conscious, you might consider repurposed rather than new. But the loan book continues to perform really strongly, but it's something we do just keep an eye on. And I think, we're declining 85% of our loan flow. We're pretty conservative in our credit risking. So we'll just keep an eye on that and monitor that.
And as the historical loan book product continues to run down, should we also expect to see that net loss ratio also kind of continue to trend down as that book rolls off? Is that fair to say on that graph that you had in the deck there?
Yeah, I think so.
Last
That's
57
still got
million.
it's got the tail of the SAC book. It's still got a bit of that auto book running off as well. So yeah, I think it'd trend down. I mean, I think we're dialed in with our credit models now that we could choose to take a little bit more risk on the new loan book. We launched that product in October and we've grown it significantly in a short period of time. It's maturing, but it's only early days. And zero default and low arrears rates are really promising. But we'll let it mature a bit. If the loss rate, it's sort of profit optimization, not loss minimization is our business. So, if you sort of started to trend down to the 10% loss rate, I think we'd probably look to take a bit more risk and grow a bigger book. But yeah, in general, I mean, that payday loan was running loss rates at circa 25%. It won't be anything like that. It'll sit in a 10 to 15% band probably, and we'll tweak just depending on the state of the economy and the opportunity in the market to grow.
Yeah. We switch gears a bit into the retail business. The luxury store rollout, is that something that can be rolled across into the UK business as well? Or do you think it might have to tweak a bit for that market, but a similar kind of concept could work in the UK?
Yeah, we've opened one store in Banbury in the UK. We have a jewelry processing centre out the back, so the floor space out the front became available. It made sense to sort of take it. It was low cost, and we stood up something similar. And I think it does apply to the UK. Originally, with the US visit, we saw this starting to become a trend, and thought, look, we had the capability to buy watches and jewelry in particular, but handbags were difficult for us to authenticate, and using some third-party AI, we can do that. So that gave us the confidence to build that line out, and we've then sort of taken that across to the UK, done the training, implemented the technology, stood that first store up in the UK. In general, the UK stores, Mark, they're a bit smaller. The high street operations are a bit smaller and tighter. It's more a pawnbroking market in the UK than anything. People are happy to pledge jewelry, which is easier to store from a pawn perspective, and the store footprint is a lot smaller, similar to Europe. But yeah, it certainly works. It's the same sort of concept, and the launch of that store about 2 months ago has been really well received online. There's a lot of hype around it, and we'd anticipate continuing that in the UK too.
Okay. And I mean, I know you talked about there's potential in the European business to maybe buy back a few stores there. I mean, the Southern Africa, Asia business. I mean, is there a possibility that that gets sold off or let go, and the capital recycled into some of these opportunities like Europe, and keeping it more focused on what you're doing in the UK and Australia, or is it decent margins, not too much of your headspace, and just kind of rolls on in the background, you collect the license fee?
Yeah, I think look, a huge sort of strategic opportunity is us refinancing, because I think with a blank sheet of paper, with some really good assets in Australia that are kind of caught in the securitization security overlay at the moment. The thing is, you look at our balance sheet, with no corporate debt other than that UK Lloyd's debt, £10 million, and the securitization facility, there's no working capital corporate debt in the business at all. So I think as we restructure and right-size our funding for our business to enable us to acquire in Oz and the UK, kind of consolidate those networks, assuming that's all running well and that sort of happens over the next 12 months, I kind of then turn my mind to, well, with that base in the UK, with a great team in the UK, and knowing the European operators in those businesses, it's kind of a logical extension to think, we'd have that option to then fold them into a European entity beyond just the UK. There's still heaps of growth in the UK. Like I say, we've just opened 2 stores in Wales, 2 corporate stores. We had none in Wales, and we could probably open 10. We've got none in the Republic of Ireland, the southern part of Ireland. So that keeps growing. So then the outer layers of Southern Africa, Asia, I think over time, logically, if we we're really in a strong position and wanted to fold them in, yes, we could do it. Like, we can value them and we can operate them, and they're more of the same. I guess it just sort of comes down to the size of the opportunity in Europe. I think is huge, and with the beachhead established and the capability there, that's a lower risk, more certain return on our capital than it would be going and acquiring one of those other networks. So, I think we'll stay very focused on growing Europe and consolidating and, generating that free cash, and then, looking at what we do with that capital.
Yeah. Question on, when do you hope to complete the refinancing? I think maybe if we broaden it out a bit, what other kind of pieces of the jigsaw puzzle have to come together before, you can actually go to the market and say, we're actually ready for a refinancing process to happen? Maybe if we look at
we in terms of the banks, we need to run the payday loan book off the balance sheet. Hence, we exited in September, about a 9-month profile. That will be cleaned up, June 30, FY26. We're done with that. That then opens all the doors that we need opened, and we move into a process of considering options. So, it will take us a little while to get this right. And I think what's happening in the private credit markets is interesting. We're just watching the events unfold in that space. When we sort of draw up our structure and consider lenders, we've got a sport for choice, hopefully. But that, it's like I think a 12-month process. I think throughout FY27, we'll look at options and what we need globally, and try and finalize something, through that period. So something like a 6 to 12-month profile, I think.
Thanks. Yeah. Okay, Sam, we are just up on time there, and I appreciate if you're in Sydney, you probably got a packed day. So I won't keep you any longer. Thanks very much again for joining us, and good luck with everything, and hopefully we can get you back on maybe a bit later in the year.
We'd love that. Thanks, Mark. Thanks for your time.
Thanks, everyone. That concludes our session for this morning, and I wish everybody a good rest of their Thursday. Thank you.